You guys have questions and I got answers. So in today's video, I'm covering how to manage risk using the questions that you guys have asked in previous comments. The 4 trading questions that I'm going to be covering in today's video all come from the same commenter, Garley, and these are great trading questions to have. The first is, how much do I risk per trade on a percentage basis? Second, do I diversify my exposure between sectors to reduce my risk? The third is, how do I manage gap downs when I'm already in the position? And fourth, what is a realistic monthly or annual return to have? The first question that we'll cover today is super important for beginning traders, and it's how much should you risk per trade? I use what's called the 1% rule, meaning I won't risk more than 1% of my entire account on any one given trade. Now, a lot of people see that and think that I'm talking about a 1% stop loss for my entry, and that's not true. The 1% of my total capital is a combination of your position size, the percent of your account in that one trade, times your risk on the trade, which is the distance between your entry point and your stop loss. When you multiply those two together, you should never be risking more than 1% of your total account. Because there are 2 factors that go into the 1% rule, we can adjust either the position sizing or our risk on the trade to make that 1%. A tighter stop loss allows for a larger position size, while the inverse is true. A wider stop is going to decrease the size of our position. A follow-up question from there might be, Nick, how do we know how wide to make our stop loss? And with that, I'd say study the history of the stock, study the personality. Look to the left of the chart and see how volatile the stock is acting. If it's a volatile stock, we need a wider stop loss and a smaller position size. If it's a very nice moving, nice trending, and tight price and volume action, then we can use a tighter stop and a larger position size. And the last thing that I want to cover on this slide is to know the market that you're trading in. The 1% total risk is a maximum amount. In a bear market, or if I'm not getting traction on recent trades, I'm not risking 1% of my total portfolio every single trade. I'm going to scale that down to maybe 0.5% or 1/4%. And I'll do that by using either tighter stops or smaller position sizing. In a bull market like we had in 2020 and the beginning part of 2021, I was using 1% or even a little bit more when I gained traction on my trades. But right now we're in a bear market. Personally, again, not getting a lot of traction on recent trades, so I'm keeping my stop loss and position sizing down to where my total risk on any trade is about 0.5%. On to question number 2. Should you diversify your investments between sectors to reduce your overall risk? As investors, long-term investors, maybe. As swing traders, absolutely not. We're only swing trading because we think we can outperform the market. Beat the S&P 500, beat the NASDAQ, one of the indexes, right? The only way we're going to outperform the market is by buying stocks that are outperforming the market. So instead of diversifying the risk away, we want to concentrate our exposure in the strongest stocks in the strongest groups. The follow-up question to this is, Nick, if we're concentrating, how do we manage our risk? And with that, we're relying on progressive exposure and stop losses to protect us. We covered stop losses on the previous slide, so let's focus on progressive exposure here. By progressive exposure, I mean that we're only going to be building exposure in the markets if we see traction on our recent trades and we have unrealized gains to risk. Let's go over an example. Say I'm 100% cash right now in the market, and I take my first trade with 10% position sizes and a 10% stop loss, totaling 1% total capital risk. If that trade starts to work for me, and say the stock breaks out 5%, 10%, it's starting to work, I can then take my stop loss that was at 10%, move it up to my entry point, and then I don't have any initial capital risk in the markets right now. By doing that, then I can then take that capital risk that we just took away by moving the stop loss up and take a new trade with 1% capital risk. Now I have 2 trades on, double the exposure in the market with the same initial capital risk. If everything goes wrong, everything stops me out, I still only risk and only lose 1% of my total account. But if we get into a trending environment where the market starts to rally for 2, 3, 4 days, I'm building more and more exposure into the market. And that's really where you get asymmetrical risk reward to your trading. Another way to de-risk is by taking partial profits on your trade. So going back to that initial example, I have a 10% position size and a 10% stop loss, 1% total capital risk. If the stock rallies up 10% and I sell half of it for a 10% gain, I can still keep my stop loss on the other half at 10%, and I still have 0% initial capital risk. And then I can take more trades in the market and still have less exposure, but still a little bit more. So to recap this slide, we do not want to diversify between sectors. As swing traders, we want to focus on the strongest stocks in the strongest groups, then use progressive exposure and rely on our stop losses to protect us. Now to the third question, how to handle a gap down in a stock that you already own. Before we get to the question that you should ask yourself, you should know to never start a position before a binary event, like earnings, FDA approval, anything like that, that either the stock's going to gap up heavy or gap down heavy. We do not want to participate in any after-hour events that's going to cause a spike or a drop in price. Why? Because stop losses don't work in after hours, so we can't manage the downside risk. So say a stock gaps down overnight on news you had no idea was going to happen. Ask yourself these 4 questions. Am I still profitable if the market opens at the current price? Will the market open below my stop loss? How large of a position size do I have, and how have recent market conditions been? So if a stock gaps down and it's above your stop loss and still above your entry point, so you're profitable on the trade, I tend to let that play out unless I have a very large position on it. If I have a large position and I haven't taken any partial profits yet, I will typically reduce risk into that move just by selling at the open and keep my stop loss on the same price for the rest. If a stock gaps down below my entry point but above my stop loss, so I'm still in the position but it's a losing position, I will also de-risk, especially if the market conditions aren't super strong. And finally, if a stock gaps down below my stop loss, I'm out right at the open. And last question we'll cover today is, what is a realistic return to expect? There are really 2 questions that should make up your expectations. Where are you at in your own trading journey? And also, what are market conditions like? At Traderline, they talk about 3 different phases that a trader could be in: unprofitable, boom and bust, and profitable. An easy way to tell which phase you're in is by looking at your equity curve or your account balance over time. If you're constantly losing money, you're unprofitable. If you're a boom and bust trader, you'll see gradual increases in your account balance and then sharp declines. And then if you're profitable, your equity curve or your account balance is constantly putting in higher lows as the market trends higher. If you're in the unprofitable phase, the goal isn't to make a lot of money yet. It's to stop losing money. If you're in the boom and bust phase, you want to smooth out your equity curve. And then if you're in the profitable phase, it's how do you gain an edge in the market? Another super important factor, and one that we can't control, that's going to impact our earnings is the market conditions. If we're trading in a roaring bull market like in 2020, where every trading style worked, our expectations should be a little bit higher. If we're trading in a bear market like we're trading in 2022, it's okay to have expectations much, much lower. We can't impose our own will on the market. Whatever the market's doing, we have to react to. Maybe a cliche answer, but it is the right one. Instead of focusing on the outcomes, focusing on the process. If you're an unprofitable trader, make the adjustments to get to a boom and bust. If you're in boom and bust, make the adjustments to make a profitable trader. And again, we're not imposing the will on the market, we're trying to interpret the market and act from there. And finally, if you have any other trading questions, make sure you're dropping them in the comments. I read every single one of the comments, and they're a great way to generate video ideas. Chances are, if you're asking a trading question, someone else also has that same question, and if I'm making content, I already know it's going to be valuable to at least one other person, probably a lot more. So if you guys enjoyed this video, please do me a huge favor, leave a like and subscribe to my channel where I make trading related videos along with watch list videos every Sunday. Have a great rest of your day, and I'll see you guys in the next video.